All right. We're going to go over some nerdy stuff related to pricing of derivative contracts. And in this case, I'm using the Black-Scholes formula. The Black-Scholes formula is generally used for European style options. That's on the index funds like the S&P 500, VIX, foreign exchange, things like that. American style are a little bit different, but we can get an estimate. And most likely you're going to be using European style because when you purchase or sell a contract on an equity, as in the United States at least, you get American style contracting. And the difference between the European and American is the ability to exercise the option. The European style only allows you to exercise it at expiration, and the American style, you can exercise at any time. And that has implications for how the option is priced. But we're going to be using the Black-Scholes here for European style. And I have the formula here for Black-Scholes. In this case, it's calculating a call option price. And I have the kind of the definitions of what things are down here. So I have the call option price on the left. I have a cumulative distribution of D1, which is down here, times the stock price, minus the cumulative distribution of D2, which is down here. And we're doing some math here on the side. D1 is essentially the logarithm of the stock price over the strike price, plus a risk-free rate, plus the square root of vol divided by 2, times the time maturity divided by the volatility, multiplied by the square root of the time horizon. I know it's kind of complicated. And D2 is just D1 minus this part, right? And I have that broken down over here. So here's the formula for D1. Here's the formula for D2. But there's some certain things that I just want to take note of that is very important to understanding options. So when you go look at the data on a MOA and you look at the different charts, when you take a bigger holistic view, a bigger picture of the market, you can understand the dynamics that if volatility as a whole is rising or volatility as a whole is falling, you can get an idea of how to position yourself. And I'm going to step through this basically. I'm just assuming this is like Apple. And if you don't know a lot of these terms, you can refer to either online resources or other tutorials that I've put out. And I'm just going to assume that you have some type of knowledge about what an expiration date is, what implied volatility is, what a risk-free rate is, and so on. So the current date now is November 18th, and the expiration I put here is for January 16th of 2026. And the T part of this that you get out of it is just subtracting those two dates and dividing by 365, and you get a number. The current stock price is 100. The strike price is 100, which is you're just buying an at the money call. The risk-free rate is 5%, so that's just like a 10-year yield, a US government yield, and the implied volatility of 20%. One thing to take note of here is that all of the inputs to calculate the option price are known except for the implied volatility. The implied volatility is the expected future volatility, as opposed to historical or realized volatility, which is something that already happened. And that's very interesting because if you knew every single outcome in the future, you can price things to perfection. And if you price them to perfection, well, technically volatility would be zero, which means you couldn't price any derivatives. And so there's a reason that you're trying to guess what the future holds, and that can come in the form of earnings reports or macroeconomic data like GDP or sector news, right? We have all these AI circular deals going on and stuff like this, and that all has to be priced into future volatility. Now, option dealers have different models and different ways of determining future volatility. And when they set prices, they do that and they have a volatility that they set. And when they have a volatility they set, they spit out an option price. And so generally what you'll see is implied volatility is much higher around earnings, contracts that cover earnings reports, because there's a lot of unknown in those earnings reports. So the price of the contract will be higher. For example, right now I have it set at 20 and the price of this call is 361. It's an at the money call. And let's just double it. Let's go to 40. Well, it goes to 679. You see that? So if the expected future volatility changes and nothing else changes, the price of the contract moves dramatically, because that is what essentially sets the price of the contract. If it's 20, it's 361. If it's 40, it's 679. See? So future implied volatility is very important to the pricing of the contract. And as we go further into the lessons, you understand why that understanding where we are in the volatility cycle is very important. So I have all the intermediate calculations here, and these are just basically taking the D1 and the D2 over here, and then running them over the cumulative normal distribution, which is basically the norm S dist function here. And we get some numbers spitted out of this. And what you'll find is that down here, skip over put call parity for now, we get some Greeks. And Greeks are some interesting information that kind of can tell us a lot about the option without really understanding much details about the option. What do I mean by that? Well, you could see that we have the first Greek here called delta. And delta is a first order Greek. And this is the derivative. It's a derivative. And this is the change. Or sometimes you'll see it as a triangle or like a caret, right? Like a change. And what this tells us is that the price of the contract up here will change by 55 cents for every $1 move in the strike price. Okay, so change in contract price for $1 move in underlying. And underlying is just what you're trading against. So Apple, right? That's here. And what you can see here, that if I put the contract price here, and then I put the delta here, 55.6, and I change this to $1, you'll see that the call price will increase by the delta. Well, not entirely. There's something called like Taylor expansion, which you have to take into account a second order Greek called gamma. And I'm kind of stepping ahead of myself, but in order to do that, you take half of the second order and you take the price of it times 1 square. There we go. Don't worry about that. I'm not going to go into details about that. But that's basically what is also going to show up in the price. There's another 2.5 cents that comes in there. And if I sum this up, you get 419. So if I change this, the stock price to 101, assuming that nothing else changes, right? The risk-free rate doesn't change. Well, those aren't going to change. If the implied volatility remains the same, then I should get 419 right here. There we go, 419, right? We got the 55 cents from the delta, and we got our 2.5 cents from the gamma. We got 419, right? So you can see that just by looking at the delta, we can see that for every $1 move in the underlying, we're going to get 55 cents on our contract. Another way to look at delta is some people say like probability of being in the money. It's basically the probability of making money, right? So 55.6% chance of making money. And the reason for that is because the delta is the ND1 right here, which is the cumulative normal distribution of D1, which basically does a summation of the entire curve starting from the left all the way to the right. and you sum up all the probabilities. Well, when you sum up all the probabilities, you get 55.6. So that's the probability of being in the money. Okay, I hope that makes sense so far. Now we have the put side of the equation, which you just minus 1. You just flip it, right? So you just do the inverse. You just minus 1. And so call Greeks are positive. Excuse me. Delta for calls is positive. Delta for puts is negative because puts are going down, calls are going up. Okay, gamma. Gamma is the second order derivative. And gamma represents the change in delta because it's the second order, right? The the delta was telling you the change in the contract price, and gamma's telling you how much delta goes up for every $1 move in the underlying. And you could have saw that last time when we made the change. So change in delta per $1 move in underlying. And so here, if I change this by 101, you should see delta go up by 5 cents. And it did. See? It went to 60. So delta just changes, tells you how much the rate of change of delta per $1 move happens. Okay. And vega is the contract. So when I say change, I'm saying um, in this case, this is like delta change, which did feed into the contract price. We did see that because I had to do that Taylor expansion of the derivatives. And when I say change, it usually relates to the contract price. And so this is the change in the contract price. And this is per 100 basis points of implied volatility. So the contract price will go up by 16.2%, excuse me, cents here if I change this by 100 basis points. So I'm just going to add 1% there. And it goes up by 16 cents. You see that? 61, 21, 77. There you go. Okay. So far, so good. Theta is how much the contract loses per day, all the way up to expiration. And actually, it's actually a curve that starts off slow if you have a lot of time left, but as you approach the expiration, it accelerates rapidly downwards like a cliff. It's like a curve that points downwards. But this is the decay of the contract per day. And right now it says almost 3.5%. So change per day lost, basically. So we're gonna lose 3.5 cents if the day increments to 19. 19, boom, you see? Nothing else changed, of course, right? The risk-free rate didn't change. The implied volatility didn't change. I'm just doing this to kind of show you the impact of things. So it went down by 3 cents. And rho is the change in the contract price per 100 basis points in the risk-free rate. Here you can see that the contract price will go up by almost 8.5 cents if bond yields went down by 100 basis points. So I'm going to do 4 here, and there you go. It went up. Sorry, it went down. Sorry, it went down. It's inverse, sorry, because we went down 100 basis points, not up 100 basis points. Sorry, I went down. But it's still a 1% change, so you minus the 8%, right? I just went the inverse. Sorry about that. So if you go down 100, it goes down by 8. If you go up 100, it goes up by 8. Okay, and that's it. That's pretty straightforward. And that's all I really wanted to cover. So you could find these calculators online everywhere, and you can derive some option contract prices and things like that. But what I really wanted to point out was the only unknown a part of an option pricing is the implied volatility. And that is incredibly important because when you're buying an option or selling an option, you're basically betting on implied volatility. That's what you're doing. If implied volatility is really high, I'm going to put it at 140. you can see that the contract price is $22.48. That's incredibly high, right? So if I buy this contract at 22.48, assuming nothing else changes, but the expected implied move in the future drops to 20, I basically lose my shirt. I lose all my money. And so if the expectation of the future is compressing, where we don't expect much volatility, then the contract prices are just naturally going to fall. And that's very important about hedging requirements on dealers, because take a look at an implied volatility of 140. Well, the delta here is 61. The gamma here is pretty much 0. And we have some other values here, but I'm really focused on delta because that's the largest component of hedging. And if I change this to 20, the delta goes from 61 to 55. Now, I didn't change the expiration, of course, which would have another impact on delta. But just changing the implied volatility knocked it down by 600 basis points, which means that the dealer would have to sell 6% of their hedges, right? Just because volatility is collapsing. So the dealer would become a net seller of those calls. And this is very important to the dynamics of volatility, and vice versa. If volatility go from 20 and it goes to 50, well, things are going to change, right? And the dealer would have to either hedge or not hedge. But very rarely do you get a single change in just one of these metrics, right? The time's going to tick over. So I'm going to tick it over to 19. The price of the contract changed. I'm going to say it went up to 105. The price of the contract changed. Risk-free rate went to 5.02, and then volatility went up by 1%. And now it's already $7.06, and delta is now 76%. So you could see that a lot of metrics changing and moving around when the formulas get spat out and back into it, that the price of the contract can dramatically change. So I hope that was informative, but the big takeaway is the Greeks that I want you to understand and kind of engrave in your brain. And the second part is the implied volatility, which is the unknown part of the equation.